So welcome back, everybody, to session 2 on day 3 of ICISA Surety Week. Feedback has been really great so far on Surety Week, which is fantastic. We're really pleased that people are enjoying it and taking a lot out of it. And in particular, we're pleased as ICISA to be shining a light on this great industry and how important it is for economies around the world. For those of you able to join us this morning, I hope you enjoyed that fascinating discussion on the differences and similarities between bank guarantees and surety bonds. If you missed that session and wish to watch it back, please make sure you were registered for that particular event, as that is the only way to receive the link to be able to view the recording once it's put on our YouTube channel. And the same goes for any of the events throughout the week. So if you weren't able to attend or you wish to watch one of the other sessions tomorrow in the future, please make sure you're registered for them. But first, I think our next discussion is sure to be one of the most interesting throughout the entire of this week. And we have a panel brimming with expertise to discuss the experience of changes in bonding law in Ontario and how that might be applicable elsewhere, particularly looking at the UK surety market. We have a chat open, as those of you who've been with us before know. Please make sure to put your comments into that throughout the session. But I'm going to hand over to the moderator now, and no one knows more about this subject probably than our moderator. That's Steve Nest, who's the president of the Surety Association of Canada. So Steve, over to you.
Thank you, Daniel. No one knows more? Okay. We'll take that for the time being. Good afternoon to everyone. Good morning to some of us. Thank you all for coming today. We're going to be talking about the bonding as it is here in the province of Ontario. But before we do that, I'd like to start with some introductions. I'm Steve Ness. I'm, as Daniel says, I'm the president of the Surety Association of Canada, the trade advocacy association that works on behalf of our industry. Been in that role for these past 20 years. Going to ask each of my colleagues to introduce themselves, 4 sentences or less, if you would. Maybe starting with Joe.
Thanks very much. So I'm Joe Shore, Senior Market Services Executive at the IUA, and among the various classes of business that I manage, I work with surety and trade credit, and I think probably later throughout this session it'll become a bit clearer where IUA fits into this kind of puzzle.
Dave.
Thanks, Steve. Good morning, good afternoon to everyone. It's really a pleasure to be joining you today. All the way from Canada, the land of the Great White North, as we call it here. And as you can all imagine, we do in fact have plenty of snow on the ground still today, so golf season is a little ways away. But I'm the National Vice President of Surety at Intact in Canada. And we're the largest surety company in Canada. Again, it's a pleasure to be with you.
Yeah, and good afternoon, good morning, everyone. I'm Richard Hazard. I head up Travelers European operation for surety. I've been kicking around the industry for the last 30 odd years or so. So hopefully today will go as well as some of the sessions that I've watched already this week.
Thank you, gentlemen. I'm just going to kick off the discussion by talking broadly about the different types of bond forms that are out there. Basically, the 2 broad distinctions, and I think you're likely familiar with those. We have the North American model, which we follow here in Canada. And here in North America, surety bonds are, for the most part, conditional instruments, only triggered once the conditions are met for a claim. On the construction side, that will usually require that the contractor be in default of their obligation, have the default declared, and that the integrity of the underlying contract is upheld. Contrast that with, as I say, that's prominent in Canada and the United States. Go to the rest of the world, as you know, we have, for the most part, unconditional demand type instruments where there is no need to establish any default of the underlying obligation. Now, as to the Ontario model, I've asked I've been asked to talk about that just a little bit, and we're going to get into a little more detail, but that comes about with a legislative change that took place in 2017 after a lot of advocacy work on behalf of various industries, ours included. And it was an effort to totally overhaul the construction payment scheme. And as part of that, we were able to establish mandatory bonding. In other words, every public project over a specified threshold is required to put up a performance bond and a labor and material payment bond. Now, those bonds themselves are, now I mentioned, of course, the conditional type obligation. I'm going to call these modern bonds in the sense that the old standard was a very simple instrument, very unprescriptive, left a lot open to interpretation, a lot of which had been interpreted by the courts. These new bonds are much more detailed. For example, the performance bond was 1 page. It's now 11 pages. And those additional pages set out exactly what's going to happen when a claim is brought forward, how a surety must act, when they must act, much more prescriptive, and therefore much more, I'm going to say, much more value added for the end user, the owner. Dave, I don't know if you want to add anything to that, anything I missed?
Yeah, sure. Maybe I'll just touch on, provide a little more background as to why this came about. Fundamentally in Canada, I think arguably many would say that the system for the construction industry was broken, and it was fraught with slow payment or non-payment, and a backlogged legal court system that resulted in protracted litigation to resolve disputes. And under this really antiquated regime, there was tremendous dissatisfaction throughout the construction industry. And so really fortuitously for the surety industry, what came about was a regime or an initiative here in the province of Ontario to resolve these problematic issues, and with the intent of an implementation of a prompt payment regime. And this was initiated through the Ministry of the Attorney General, and that was a key driver behind this, is that there was the political will within the province to bring about change, and a renowned construction and surety attorney was commissioned to lead this and embarked on dialogue with all stakeholders in the industry. And ultimately, as a part of the prompt payment initiative, there was the need to address securitization, so that ultimately it created, and the goal was to create a pool of funds, and that would provide for payment certainty in the event of contractor default. And analysis was done, both on looking at letters of credit, looking at many of our government agencies had relied on bonding. Some, though, would self-insure. And ultimately, it was determined that bonding was the way to go, because here, historically, 50% bonds were required, unlike in the United States, where they are 100% performance and payment bonds. So it was felt that those bonds would provide a pool of funds that would enable and facilitate payment certainty down the chain of the construction pyramid in the event of failure. And so that's really was the driver. It was this desire to have prompt payment legislation, which brought with it a UK-based adjudication model, and then the modernized bond forms that Steve referenced to provide for the pool of funds, both on the labor and material payment side and for project completion on the performance side.
Thanks, Dave. Richard, wonder if you could maybe jump in here and talk about the UK now, and perhaps go over some of the ways that this model may be adapted for use in the UK under the current market conditions there.
Sure. If you look at the UK market, we vary from your North American market. The UK tends to be a conditional market versus an on-demand, but contractual security packages vary. Everything is discretionary, nothing is mandatory. There tend to be 3 options, and it can be a mix of these. So you'll have performance bonds, letters of credit, or parental company guarantees. If you're going the performance bond or letter of credit route, they tend to be 10% of contract value. The performance bonds will tend to be conditional, whereas a letter of credit will tend to be on demand. And when you look at that parental company guarantee side of things, it all depends what you're trying to actually achieve. Because if we jump ahead to Carillion, which is kind of what triggered our view of the Ontario market here, of course, their catastrophic failure meant that not only did the company fail and stop actually delivering its projects, but the parental company guarantees that a lot of employers had taken to give them security fell away as well, because there was no financial wherewithal there to support them. So we kind of then looked at what our participation had been, and where there were contracts that Carillion had participated on, where there were performance bonds issued. I'm pleased to say that the 3 sureties involved all acted very quickly, very promptly, engaged in the discussion with the various employers, and fairly quickly, of course, this is helped by the situation of Carillion's catastrophic failure, but very quickly came to the conclusion that we had to pay out, and pretty much full payout on all bond values that were out there. And then once we'd had time to actually look at what had happened, as time moves on, what we found was that on some projects, not only were there performance bonds, but there were also letters of credit. The bonds paid out, the letters of credit paid out, but the overall contractual security package for that contract was insufficient, such that the employers then had to postpone works, defer works, while they went out to try and raise additional capital to make good on the shortfall on the contracts. And I've got an example which I can go into a little later. But that then made us start looking at other alternatives, because our product had done exactly what it said on the tin. We paid out the 10%, we paid it promptly, it was paid into the project, but the overall security that was taken was insufficient to help the employer. So we started to look at ways in which we could try and help the employer actually avoid that situation in the future, get that money into the projects, get the projects completed as quickly as we could. And we looked at the North American market. So there were the 100-100 performance and payment bonds in the US, the 50-50 in Canada, and the sort of potential 30% performance bonds on major projects down in Brazil. We discounted the US route fairly quickly, because a jump from a discretionary 10% bond to a mandatory 100% performance, 100% payment bond seemed like too far of a stretch. But with Ontario just having literally gone through this, just having adopted it, having a legal system that comes from a similar background, a construction industry that is roughly the same size as the UK market as a percentage of GDP, that kind of felt like a potential good fit that we could potentially start to explore to see if we could move our market that way to help get these projects finished without the sort of issues that we saw on Carillion with projects being delayed significantly.
Okay, we will get back to you because I'm hankering to hear about this example that you mentioned, but just before we get there, just to talk a little bit about what's happened in Ontario since mandatory bonding has been in place now for 3.5 years, as have most of the changes under the revised Builders Lien Act. Some of them came into effect about 1.5 years later. But what we've seen has been very encouraging. First of all, David mentioned, of course, we brought in a prompt payment regime that was reinforced by adjudication, by the ability to adjudicate any disputes. And that particular provision of the Act has been enforced now 2 years. And one of the things that's been astounding, at least to me, is how seldom that ability to adjudicate has been used. And looking into it a little deeper, it appears that the Act is fulfilling what it was really intended to do, and that was to drive better behavior, make payment more prompt. People can't play games anymore. They can't engage in frivolous disputes because now they're going to find themselves in front of an adjudicator, and so there's a much more down to business approach with the payors now just simply doing what the contract brings them to do. As far as bonding itself goes, we found remarkable acceptance of it. People who had previously resisted bonds pretty much accepted now that bonds are going to be the order of the day. And I guess it had a very good effect on our industry in 2019, which was the first full year of mandatory bonding. Surety volume in Ontario went up 28%, which is always encouraging from our perspective. But claims have not increased exorbitantly, even in the wake of the global pandemic. We haven't really had it tested that strongly in terms of claims. I've been made aware of a couple of instances, but no, I'm going to say high-profile defaults have since been brought to my attention. Dave, I don't know if you can have anything to add on that or any experience on it. So no, that will remain to be seen. But okay. Richard, you were talking about that Carillion. You were going to give us an example. I'm sitting here with bated breath.
Okay, well, I can talk about this because it's one of the projects that we bonded. But what I would say is all of the information that I'm about to say, I went through and got this from public websites, so I'm not releasing anything that is private. Okay, we bonded a project called Midland Metropolitan Hospital. It was to be a new hospital based just outside Birmingham, which is in the centre of the UK. It was going to be bringing together 3 older, smaller hospitals all onto one site, and those 3 other hospitals would then be repurposed into specific functions, I believe. The original capital cost of the project was going to be £297 million, and it was due to be completed in October 2018. The project was it went ahead under the UK's PFI programme, which was the private finance initiative. So essentially, it was a concession that was released by the government to a consortium that was composed of funders, contractor, and an O&M operator. So they bid it, and effectively they then go away, design, build it, finance and operate it for 25, 30 years, and then hand it back to the government. The government paying in that concession period by way of an availability payment. Everything was going along okay, but Carillion hit a design problem probably around June of 2017. And the design problem was such that they weren't getting the necessary drawings that they needed so that they could actually build something and anticipate where the M&E various holes and segments were needed for the M&E kit. So they agreed with the employer that they would effectively down tools until they had the drawings, because otherwise they were going to be building things as they knocked them down. So the shell and core was all up, but a lot of the internal structures and walls and so on were not. And then in January 18, Carillion catastrophically failed. After about 3 months of valiant attempts amongst various parties to keep it afloat, it failed. So Skanska looked at supporting that project, and they offered to come in and complete it for an additional £125 million, and with an 18-month delay to the project. But a bit later on, the banks withdrew their funding for the project, and HM Treasury cancelled the PFI project, which meant that effectively the government then buys back the asset as is made, but then has to find another way to actually try and complete the project. Balfour Beatty were awarded an interim contract, really just to protect the site and make sure that none of the works deteriorated too far, in October 18, and that was for £13 million. They then went on to become the only bidder to complete the works, and they agreed to complete it at the end of 2019 for an additional £267 million. We are now looking at that hospital being complete at during the course of next year, 2023, which will be 5 years late and more than 40% over budget. And so, you know, when we look at it, the bond paid out, letters of credit paid out, and they just got swallowed into the mix of while people were trying to resolve things, the liquidated damages, the interest costs because it was a PFI project, and all of that sort of thing. So when we started to talk about how we could do things differently, certainly that hospital and another hospital also in the north of England were two key projects that we were looking at that could potentially have really benefited from having bonding. But to be honest, across the board, all of our bonds paid out in full, and I think only one of the projects actually didn't require the employer to put more money into the project after we'd paid out. So that's what triggered our look at the general market. And to link in with something you said, Steve, you know, the adjudication model actually came into the UK by way of the Housing Grant Construction and Regeneration Act in 1996. And the PFI model that was devised actually took fairly early advantage of that and incorporated that into a bond form. And now what we're seeing in everyday bonding is a higher frequency of adjudication bonds being issued just as the norm. Now then, they're still only 10% of the original contract value, but adjudication is being used frequently, and actually is been going in excess of 20 years now. So we do have quite a lot of adjudication experience and case law and so on, just tracking how that works. And so far, I think most people are fairly comfortable with it. The adjudicators have done a very good job.
Richard, just to add to that, Carillion, as you know, and I'm not sure many of you out there do, Carillion did have a Canadian operation. And when Carillion failed, there were a number of bonds outstanding. And, you know, Richard referred to the perils of a low penalty bond, as in 10%. Well, the province of Alberta engages contractors to do winter maintenance projects. You know, they're ongoing 5-year terms to clear the highway of snow and fix repairs and all that sort of stuff. And they had very, very low penalty bonds. It was in some cases less than 10%. And when Carillion failed, the province of Alberta Transportation Department got stuck with a nasty bill. They were almost immediately on the phone to us. We sat down and talked to them. Now, province of Alberta requires 50% bonds on winter maintenance contracts. So, you know, case in point. I'd like to bring Joe into the discussion. I mean, Richard talked about the UK and the potential for importing the Ontario model into the UK. Just wondering if you could comment, Joe, on some of the efforts or some of the discussions that have been held with stakeholders and the powers that be to maybe push things in that direction. I don't know if you can add anything to that.
Yeah, well, we had discussions with Richard and other sureties where they were outlining some of the points that Richard's made earlier. But there is quite a compelling argument to look at a different model, and I think you know, as Steve and David, as you mentioned earlier, there is some compelling evidence of it working elsewhere. So the starting point for us is if we're going to have those conversations, do we have the structures in place to have those in the market? And I think the view amongst sureties was that they didn't have a market body or London market body where they were able to meet, discuss, you know, engage with brokers, or even have kind of day-to-day discussions about what's happening in the surety market. So that was our starting point. And although it started looking at the Canadian model, and that's been probably the primary discussion point amongst the sureties, it became apparent that it would be useful just to have a committee established under a larger market body that's operating in the London market, that can be a kind of face and a hub for a lot of these discussions. So, and I think the reason, well, I don't want to speak for Richard, but I think the reason that that the IUA was engaged is that we made sense as an association that represents the London company market, and particularly for surety, none of that business is written within Lloyd's. And in fact, I think a lot of the sureties in the London market are IUA members already, and we have, I think, as I mentioned earlier, we represent pretty much every class of insurance, you know, which includes obviously sureties will be involved in a lot of those classes of business, and we have the functions to look at model wordings. We have the functions to kind of set up market meetings in a competition law compliant way. And I noted Richard earlier already clarified that he got all of his information from public sources. So that's the type of thing that we have training for, looking at market modernization efforts as well. So we've got kind of got that structure in place. So it's very easy for us to set up an IUA surety committee and bring all of those discussions under the IUA umbrella. And that committee has actually been in operation for about a year now, which time flies during COVID. And we've actually, hopefully, we'll be able to get some more in-person meetings happening soon. But that's allowed us to have, and I think, Steve, you mentioned earlier, and David, you also mentioned earlier, that when we're looking at something as big as changing the model for how this business operates, there's a lot of other moving pieces that will need to be modernized as well and looked at. So our members have very quickly kind of started looking at, can we update the model wordings? And I think the idea is yes, we definitely can, and we've started looking at those and I think at the moment what we've tried to focus on is bringing the amendments in that sureties are making all the time. I think we tried to work out when the last market model wordings were published, and it was a very, very long time ago. And that was back when surety was represented with a group under the ABI. So we're very keen to make sure that those are modernised, updated, and incorporate the changes that we'd like to see. And we're also looking at things like statistics, and that's something that the IUA has quite a lot of experience with in collecting from firms. We want to make sure that we've got up-to-date, regular market statistics, and I think that's something that most sureties would say we can improve on as a market. It's very difficult to start making arguments either internally or externally without those statistics. And also looking at things like e-signing, just making sure that we are being market leaders, and that's the type of thing where it's quite difficult to do as individual sureties. But when you have a market group that can come together and say, this is what we want to do, we want to push forward and try and modernize this industry, it makes it a lot easier. So there's a number of different things that we have been doing. I mean, one of the other things that is quite useful for us to do is to be able to engage with other associations. And I think this panel is a very, very good example of being able to take some work that we're doing collectively as an industry and be able to present that externally. So I think that's, I don't know if we'll come on to perhaps some of the advocacy work that we're doing in a moment, specific to the Canadian model, but I think that gives an idea of what we've tried to do with creating an overall structure for these discussions.
Actually, that's a good segue into that. Some of the advocacy efforts. I mean, I was sort of smack dab in the middle of a lot of the efforts in Ontario. And Dave mentioned earlier, and I think this was the cornerstone of it. There had to be the political will, and there was a strong need across the construction industry that we were all able to get behind. That money needed to flow down the construction chain. There was in place what I called a culture of non-compliance. That sure, the contract says you have to pay in 30 days, but we all know that 30 really means 60 or 90 or whatever. And of course, the problem is as you go down the construction pyramid, the top guy's 60 days becomes the next guy's 90, becomes the next guy's 120, so on until it lands on the shoulders of the poor slob right at the bottom of the food chain, who is least able to finance it and becomes essentially the bank for the project. So that was a problem, and we were all able to get behind that. And of course, we showed up with our argument. First of all, in the surety world, no one is more supportive of prompt payment because we're the people who have to clean up the mess when payment isn't prompt and failures result. So we got right behind that, but we also brought something else to the table. We brought the new bond forms that had strict timelines, and this is particularly on the payment bond, for payment. So not only do we reinforce prompt payment, but we provide certainty of payment. What if that contractor now becomes financially distressed at the head level or insolvent? You can be as prompt as you want. If you don't have any money to pay, it's the old, hey, I don't have anything to pay you, but I'll pay it to you right away. Not much good to you. So we brought that element of certainty, and that's how we were able to get ourselves into the conversation around that, because we reinforced it. Now, the other, and this is a little bit subtle, the other part of our advocacy effort was not to over-advocate. This was not about surety bonding. Surety bonding was a tool that reinforced it, but we didn't want to be leading the charge and hence get a target on our back. So we assumed a supporting role, kept our head down, if you will, and I think that served us very well with the ultimate result of getting mandatory bonding brought into the legislation. I don't know, Dave, do you have anything to add to that? Did I leave any holes?
Yeah, no, that well said, Steve. One thing I just wanted to comment on quickly is really what we had, what the situation was before bringing in this new act and the new bond form. In the province of Ontario, we were often collaborating as an industry, a surety industry, with public owners who had their own attorneys, be it at the municipal level, cities, provincial agencies. And in dealing with those attorneys, we found they often wanted to prescribe their own bond forms. They had their own thoughts on how a bond should act. And so there were a myriad of wordings some a little more progressive, some very antiquated. And that environment of scattered bond forms throughout the industry, I would say it resulted in an environment of just general dissatisfaction in the surety product, because frankly, a lot of the wordings were not prescriptive, and subject to a lot of interpretation, lacked time-tested jurisprudence as new clauses were inserted. So it was really not a very effective environment. So I would suggest that in any advocacy efforts to in this direction for mandatory bonding, that as Steve said, we brought forth a new modernized form for standardization, and that is I think long-term going to serve our industry very, very well, because it is so prescriptive. So it does force us as an industry to up our game from a claims handling perspective. We're now starting to see claims on these forms, and it does force us to move very quickly. And so there was also an education process of the contracting community as to, because they are also signatories to the bonds, so they need to be ready. And if they're still solvent, there is the need for them to be able to provide us with the information in very timely fashion about the status of the dispute, so that if there is legitimacy to their position, we need to be in a position to, with knowledge and evidence, advocate on their behalf. Because again, it is a conditional instrument. So that's been, I think, a really great outcome in all of this. Steve, you were also asking just about the claim activity. In 2020, as the pandemic started, I think a lot of companies set up and were anticipating more claim activity, and there was a lot of IBNR put up reserving for that. So we did see our industry loss ratio go up to about 41%, I think, is by my calculations, I think was the number. And then through Q3 of 2021, the industry statistics would show that's come back down around 26%. So, but anecdotally, not a lot of claim activity, mostly smaller, no large high-profile defaults really across the industry in the past couple of years, which is terrific, and we keep our fingers crossed.
If I can just add one thing, Dave, before handing it over. This is again on the advocacy and bringing it about again to the political will. The government of the day was determined that this was going to happen. They bought into it all the way. And they were determined it was going to work. So there was an extensive consultation process conducted by a surety-friendly lawyer, as Dave said. That took the better part of 2 years. And they spoke to everyone and published a 100-page report with a series of recommendations, almost all of which were adopted. And the report, appropriately enough, was called Striking the Balance, because it aimed to be a balanced approach to solving the problem. They were determined to solve the problem, not just redistribute the grief that came from not solving the problem. So nobody got everything they wanted. We all had to give up a little bit. There's an old saying that the best deal in the world is the one that makes everyone equally unhappy. Well, that's what this did. I mean, we all gave up something, and that's why it got the strict buyout. Now, there was a lot of political pressure from various special interests. We had the home builders and others that thought they should be exempt from prompt payment. Well, the Attorney General, to his unending credit said, nope, this is everybody. Quite seriously, I was in a meeting with the Attorney General of Ontario when someone suggested that, and he actually picked up a box of tissue, pulled out a Kleenex and said, here, go have a good cry, blow your nose, because this is going to be the way it is. And as a result, we've got what I think is a pretty balanced and workable document. Just either Richard or Joe, anything you can add on advocacy efforts or potential advocacy approaches in the UK?
Yeah, I think from our perspective, when we first started talking to the IUA, firstly, they were very open to the idea of supporting this because they could see the benefits across the piece. So without a shadow of doubt, the surety industry will benefit from this, but equally the employers, governments, etc., will benefit from a better bonding product or a higher bonding product that protects more and potentially brings in that payment bond concept as well, the same as you have in Canada. And as Joe said earlier, what we've done is sort of opened that up, and there are now a variety of subcommittees that are driving other things below this level. But in terms of the Ontario model, certainly we've brought the market together, which is something that hadn't been done for many years, which is a really good thing because we need the market to talk to each other to ensure that we're getting the product right and we're keeping the product modern and everybody is on the same page and operating in a responsible way. And that sounds really crass, but just everybody really understands what we're all trying to do and we're all moving largely in the same direction. Doesn't interfere with competition or anything like that, but just generally trying to make the product move forwards. And certainly, in terms of we actually call what we're trying to do Project Ontario. So in terms of that, we need the whole market to be there because there's no reason why certain markets have all the right answers. Everybody has a valid opinion and a valid viewpoint that others may not have thought of. So we need that. We need to develop the market so that the underwriting changes, because if we do shift to a more North American approach, the underwriting approach is very different from the underwriting approach that we traditionally use here in the UK and Europe. And then thirdly, we need the market to move along as a whole anyway, so that we can ensure that we get sufficient capacity, because it's one thing saying, look, actually this is a good product, but then we need to have the capacity there to actually deliver, because suddenly you're going to be having a lot more contractors, a lot more bonds coming in for a lot higher percentage. So we need to adapt the models of how we track exposure, potentially bringing in WIP schedules and all that sort of thing. So we need that whole market to come together, and the IUA have done a great job of bringing everybody in and helping that to move forward as a general consensus discussion. And then on top of that, we just had a meeting. We are in the same way as you did in your market. We are talking to an external economic modeler and advisor. And the IUA are doing a great job of sort of bringing that together and getting everyone to pitch in and support the underlying cost of that, because of course government isn't going to move or change anything until they can see the actual numbers behind it. So the first point really is that we all have to be in this together. We all have to move in one direction together, and largely that's where we're going. I think we're moving in the right direction. I'd like us to move a little bit quicker, but we're generally moving in the right direction, I think.
Yeah, no, I'd agree with Richard on that. It definitely seems to be gaining momentum, even though we're at what I'd say is a relatively early stage. Just having heard from you both about the types of challenges that we'll probably have to face moving forward. I think, as Richard said, and thank you, Richard, for your nice comments about the IUA and our engagement so far. But I think bringing everyone along for the journey and making sure they're involved at an early stage, and that's both the market and speaking with people within the UK government, I think is very important, because it's giving us kind of the feeling of support, so we know that this is something that's viable and something that particularly government are open to. But also those early market meetings, making sure that we had both sureties, non-IUA members, brokers there as well. I think, as I said earlier, if it's going to be a big change potentially if all of this goes through and happens as kind of the way that we're looking at. And you don't want that to be a surprise for people. You want them to be involved in those discussions, so that even if we do end up with something that is kind of a bit of a compromise that nobody's fully happy with, at least they've been involved with it. I think it's a lot easier to accept change when you've had your say and had the input there. But I think just to add to what Richard said, we do have quite a good relationship with the people at the Department for Business, Energy and Industrial Strategy, or BEIS, in the UK, and they have been open to seeing the data once we have the Canadian data model, get the data from that. They're really interested to see what we put forward with that, and I think generally that they are quite open to looking at what is quite a radical shift, which is promising, and I think when you're talking about the political will and even looking at what's happening at the moment in the political sphere, I think we're quite conscious that political will can potentially change quite quickly. So we want to make sure that we have market backing and solid data to support that argument, because I think, even looking at this presentation, when you lay the argument out and lay the position out, it is quite a strong position. I think it does make you want to support that type of movement. So we're making sure that we kind of put our best foot forward and get everyone together so that we can react to political change and hopefully continue to have the support of government in what we're doing. But the data is definitely a big factor here in terms of supporting the points that we're making.
Just before we offer our final comments, I'm just going to throw an observation from a dumb Canuck outsider here. From my perspective, the powers that be in the ministry, I think you must have their undivided attention after getting that huge bill from Carillion. Should be a bigger attention getter than that. So hopefully that will grease the wheels a little bit for you. With that, gentlemen, any closing comments before we hand it over to our audience for questions?
Sure, I might jump in and just suggest that you may also find that the subcontracting community is an advocacy group that are stakeholders that may really assist you as well, because of course they are the beneficiaries of the pool of funds that are available through a payment bond. And certainly it's been our experience here, when projects are not bonded, when government agencies are not taking bonds, that there's a loud cry from those subtrades on public work when the project has defaulted and they're left unpaid. And as taxpayers on government work, they've been expecting to get paid. And in the absence of a bond, they're not. And so you've got, that's where it sort of drives some of the political will, is these are family-run businesses very often, and taxpayers who have been left in the lurch. And so if they understand the mechanisms of the payment bond, they may be a group that can really get on side and support this. And I think that's where, the efforts can be, it begins with an education process of all the stakeholders on the benefits, and may well find that there are many that that will also be supportive, and then we don't look quite so self-serving as an industry trying to sell a product. Secondly, I'll just comment about the adequacy of the 50% bond. First of all, in the province of Ontario, what is prescribed by law is only the head contract between the general contractor and the owner is what is required to be bonded. As to whether general contractors are going to take bonds from their subcontractors, that is up to them in their management of risk strategies. So it is prescribed in the head contract as a 50% bond. You know, from my experience in, you know, well over 30 years in this industry, I would say probably in the high 90 percentile, that is adequate. We don't have probably specific data available on that, but anecdotally, I can share that. In the odd case, the 50% bonds have proven to not be adequate, and in the Act, it does. It really is a minimum requirement. So if a public owner was to look at a particular project, perhaps something really unique, where they think that in the event of failure, the bill could be huge. Perhaps if there's performance guarantees or otherwise, which of course we try to often avoid or mitigate significantly, but those might be a circumstance where an owner could prescribe a higher percentage bond and choose to take 100%.
Just to echo that, I used to make an honest living like Dave does now. And when I was on the front lines of all the years I was there was only one instance, one claim where a 50% bond was not sufficient in my experience. And in that particular case, 100% wouldn't have been sufficient. So I still wake up in a cold sweat thinking about that one.
Yeah, and to follow on from those points, I think that was one of the other things when we looked at the Ontario model, that 50% captures pretty much everything. It's very rare that you see loss ratios on any individual project going in excess of that level. So for us, when we're working on advocating this within the UK, that 50% seemed to be a sensible number. I think also, when we're looking at it as a market, that information that we're going to get from the independent modeler is going to be really interesting, because we have a slightly different market to North America, because we have trade credit insurance, which is a big product here in Europe, whereas I know in North America it's utilized a lot less. And so, there are those trade credit insurers who are looking at that payment bond versus the trade credit side and so on. So certainly when the models come out, we will be able to look at what is the best response that will support contractors and getting contracts finished as we go forward.
Yeah, and I just add from an IUA perspective that I think, as I mentioned at the start, we have a trade credit committee, and quite, even working with ICISA, we're quite well, quite deeply involved in that class of business. So when it comes to looking at the data and making those arguments, hopefully the IUA will be able to add value and kind of have those discussions with the trade credit market as well. But I think I keep coming back to how important the data is, but I think that really is going to underpin a lot of the arguments that we make going forward. So it is, that for us is kind of the crucial part of where we'd see the future lobbying efforts going. And as the IUA, we have quite close links in with government on a number of different areas. Whether it's to do it, them contacting us, wanting some views on retention bonds for surety or non-surety issues that are kind of tangentially related, like construction and construction PI. So hopefully we are positioning ourselves as an association that works with government rather than lobbying government for things that the market wants to see. So you know, I would hope that once we get that data and we can make this argument, we can put together, you know, a position that just makes sense rather than something that just serves sureties.
And that may be where the Ontario model really helps you, because it was not at our initiative. It was really a government-driven initiative to find solutions, and that was the ultimate outcome. And I think as Steve referenced, the striking the balance document that was prepared may be a very useful reference and tool for people to consider looking at. And now, with a few years' experience under our belt, fortunately, what we're now seeing is it's now spreading to other jurisdictions within Canada, to other provinces that are now modeling their prompt payment initiatives and bonding requirements based on the Ontario model. So perhaps we could suggest, you know, it takes time, but maybe throughout Europe you'll see someday where if it becomes successful in one jurisdiction, that might be the impetus to have success and drive solutions elsewhere.
I checked the questions box, and it seems that most of the questions asked were subsequently answered by other participants. So, thank you to those who offered the answers. I'm just going to end by saying, or an offer, if you will, to Richard and to Joe, if the Surety Association of Canada can be of any assistance to you in formulating and delivering your advocacy efforts, we're happy to do so. You know where to find me. We're prepared to provide you with background such as we have, and you know, would love to become involved and see this thing take off for you.
Thank you, Steve.
Yep, thank you very much. I mean, even the conversations that we've had on this panel, I think it's both Richard and I have agreed it's raised a lot of things for us to think about, and a lot of lessons to have learned already.
All right. I don't think there are any other questions. Oh, wait, we have one. Here's one that I really can't speak to, but maybe someone else can. How do you see the India surety market post the IRDAO guidelines? I actually did see the guidelines. They seem to, on first reading, and I'd have to study these more, be favorable to the adoption of a surety product in India. But that's something I would have to familiarize myself with a little more, and it's something that we're going to be looking at in the internet with the International Surety Association. And as my friend Richard Wolf points out, yeah, that's the subject of the panel tomorrow morning. So stay tuned and attend that session. I won't, by the way. You guys hold your morning sessions at 4 o'clock in the morning for me. I have a meeting at that time. With that, back to Daniel.
Yes, and unfortunately, Steve, I think, as Richard pointed out, it is recorded, so you will be able to watch that back and hear about that. But yes, tomorrow morning in Dutch time is the Surety in Emerging Markets, where India will be a core focus of that session, and how the new guidelines there will maybe impact the market there. And then in the afternoon, we've got a focus on women in surety as well. So I think two really important topics to end Surety Week. But all that's left is to thank everyone on the panel for a fantastic conversation, really, really interesting. And just to add that we as ICISA are behind all these efforts completely, and we're here to support you all as well. So thank you very much for your contributions today, and thank you to all the guests for attending as well, and for having a really interesting conversation in the chat as well.
It's a pleasure. Thank you.
Cheers. Thank you very much.
Great.
Thank you.
Have a good day. Bye.
Best to ICISA.
Bye.